Welcome back to Alpha Recap, your quick post-market rundown from stockalpha.ai. Markets had a pretty mixed day, and we're here to unpack why. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. The close brought a real sector-by-sector story. Some big winners, some clear losers, and a lot of rotation underneath the surface.
Exactly. To kick things off, the headline was geopolitical risk around the Strait of Hormuz, which pushed energy higher, and Bitcoin staged another rally above $73,000. Tech kept an upbeat tone thanks to AI upgrades and a new Apple Mac launch. But industrials and some parts of financials and real estate were under pressure.
Right, and that meant markets closed mixed rather than a clean risk-on day. Different catalysts drove different pockets of the market.
So, what really stands out here is the way one event, the Hormuz strikes, rippled through energy, shipping, and even inflation expectations. Oil and liquefied natural gas prices re-rated pretty quickly.
Traders were pricing in near-term scarcity. Broker notes even raised second-quarter price forecasts for Brent and WTI, and energy equities outperformed accordingly.
And on crypto, the narrative was institutional adoption. Scotiabank launched a low-fee multi-crypto ETF, and Kraken secured a Federal Reserve master account, which helped Bitcoin push above $73,000 mid-session. That's structural stuff, not just retail speculation.
Exactly. Institutional flows and custody wins reduce friction for big investors, which makes crypto more tied to macro liquidity and ETF flows.
Quick reactions. Big move.
Not what anyone expected.
Yeah, that tracks.
Let's break this down sector by sector, starting with the outperformers.
Energy led the charge. Strikes near the Strait of Hormuz and halted shipments tightened supply perceptions. Traders pushed crude and gas prices higher, and energy names outperformed. If you were overweight integrated producers or service companies, you likely saw gains.
Right, and that's important, because energy moves act like a macro input. Higher fuel and freight costs can squeeze margins elsewhere, especially in industrials and transport.
Tell me about it. Industrials and manufacturing felt that pinch. Tariffs, higher fuel bills, shipping disruption. Companies with long, complex supply chains saw margin risk and guidance uncertainty.
Yeah, that was a tougher day for that group. It's one of those times when the cost side moves faster than companies can pass prices along.
On the crypto side, we saw productization, spot ETF flows, a low-fee multi-crypto ETF, and custody wins. That combination is drawing institutional money into regulated wrappers, which matters for portfolio construction.
Investors should think about defined allocations with tight risk controls. Small, measured positions via regulated ETFs, rather than big, direct exposures, unless you really know custody risks and rebalancing rules.
A 1 to 3% allocation recommendation makes sense for many investors. Dollar cost averaging into those ETF vehicles can reduce timing risk.
Switching gears to technology and communications. This was a constructive area. Google rolled out AI upgrades, Apple launched new Macs, and Starlink revealed Starlink Mobile. That combination supported demand narratives for software, cloud compute, and chips.
Right, and when you connect that trio, compute demand, software monetization, and content distribution, you see a feedback loop. More AI features mean more cloud compute and more chips, which helps chip designers and cloud providers.
And there was also a pretty notable media and communications financing moment. Create Music Group raised $450 million, which signals investor appetite for scale in content and distribution.
Short reaction. Big financing there.
Absolutely.
Now, utilities and materials also had a good day on project headlines. A 30 gigawatt-hour iron air storage project, Alabama Power's first state battery energy storage system, and a 700 megawatt wind plus storage deal with a major tech company. Those are the kinds of projects that support a long run of grid modernization investment.
And don't forget rare earth project moves in Kazakhstan, Australia, and Chile. Those headlines reinforce the narrative around critical minerals and recycling, though these are long-cycle investments.
So, in plain English, that means money is moving into long-duration infrastructure, and certain utilities and storage suppliers have real growth on the books.
Exactly, but the sector is bifurcating. Traditional rate-based utilities versus growth-oriented project developers and equipment suppliers.
Let's hit underperformers briefly. Besides industrials, parts of financials showed cracks. Regulatory noise, changes around OCC thresholds, scrutiny of exchange ownership and stablecoins created uncertainty. Even with some positives like Kraken's FedMaster account, the overall backdrop felt mixed.
Policy and regulation were a real theme across the day. Cannabis, crypto, and parts of healthcare are all super sensitive to regulatory headlines. Positive state ballot wins helped cannabis, but it's still a patchwork risk.
Quick hit. Cannabis got a policy tailwind in a few states, which kept that cyclical trade alive.
Meanwhile, real estate had big-ticket transactions. A $427 million land purchase in Ashburn by a large e-commerce company. A long lease at a marquee midtown property. And industrial deliveries, like a 219,000 square foot facility from a big industrial developer.
Those deals show capital is still chasing high-quality logistics and long-term leases, even as zoning, taxation, and office reuse debates keep parts of the sector under pressure.
The takeaway for real estate was selective. Overweight high-quality logistics and certain life science hubs. Underweight challenged metro office, where vacancy and capital expenditures are tough.
Okay, time for cross-sector themes, the big picture links we saw.
First, geopolitical risk repriced energy and shipping, and that fed into industrial costs and inflation expectations. Second, crypto productization meant more institutional access, increasing correlation between crypto and macro liquidity.
Third, AI product upgrades continued to lift tech and media through compute demand and platform monetization. Fourth, grid modernization and big storage projects signaled a multi-year CapEx cycle into renewables and storage.
Finally, and we've said this before, policy and regulation remain a bifurcation force. Where regulation loosens, you can see multi-year growth. Where scrutiny increases, valuations compress fast.
Let's translate that into actionable ideas. What could investors actually do near term?
Tactically, favor energy exposure, but hedge for volatility. Geopolitical supply tightness can lift prices quickly, but the path can be noisy. Options or sized short puts are sensible risk tools.
For crypto, move from curiosity to a defined allocation with tight size constraints. Use regulated spot ETFs or low-fee multi-crypto ETFs. Rebalance on volatility and set strict position limits.
In tech and communications, be selective. Favor AI infrastructure, cloud providers, and chip designers with clear monetization. Hardware demand is worth watching through Apple's launch for consumer upgrade signals.
For utilities and materials, tilt to project-oriented exposure. Companies building storage, renewables, and recycling capacity. Consider ETFs in clean energy and materials to get diversified upside.
For industrials and logistics, favor balance sheet strength and pricing power. Higher fuel and freight costs compress margins. Look for automation, robotics, and supply chain software names that can improve productivity.
And for real estate, focus on quality and cash flow resilience. Logistics and high-quality multifamily in supply-constrained markets looked best on the day.
A quick risk checklist. Escalation in the Gulf beyond current strikes. A sudden reversal in risk appetite that drains ETF flows into crypto. Regulatory shocks in the US or EU around crypto or AI. Or a rapid easing of commodity tightness that removes the energy premium.
Short reaction, watch the headlines.
Right, a few names and areas to monitor. Integrated energy producers and energy ETFs for energy exposure. Regulated spot crypto ETFs and custody plays for crypto. Nvidia and cloud providers for AI compute. Apple as a hardware demand signal. Utilities and project developers tied to storage. And logistics-focused real estate operators for industrial exposure.
And remember, none of those are endorsements to buy right now. They're starting points for further research and position sizing.
Exactly. The medium-term watch list is threefold. Whether oil and gas tightness persists, how flows into regulated crypto products evolve, and the pace at which AI turns into durable revenue for cloud and chip providers.
If those trends hold, they'll shape cross-asset correlations and the next leg of market leadership.
Final takeaways. Markets closed mixed after a sector rotation. Energy and crypto were clear leaders on supply and product flows. Tech stayed constructive on AI and device upgrades. Industrials, select financials, and parts of real estate faced headwinds from costs and policy uncertainty.
So be selective. Lean into energy and AI where you have conviction, keep position sizes disciplined, and use hedges or ETFs to manage single-name risk.
And keep an eye on headlines. Geopolitical moves and regulatory shifts remain the biggest wildcards for this cycle.
All right, that's our recap for the day. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for joining us. We'll be back after the next close with another sector recap. Take care.